And we had the best economy we've ever had.
And then one day you have to close it down
In order to defeat this enemy.
When things go wrong, knowledge is power. This is Money Talks.
We're back. I'm Troy Harmon here with Jarrett McKenzie.
Yes, sir. Glad to be
All
back.
the way from Paulding County.
All the way.
You've made it. Paulding County, at least, has made it to the national news with their school happenings.
Yeah. Been quite a bit going on out there, but with 5 kids in the house after 5 months of being stuck in the house,
it's time to go to school. All right. We also have Jennifer Thomas. Jennifer Thomas is joining us remotely. Hey, Jennifer. She's doing her part to keep the virus at bay, and I guess
allowing us to be a little more spread out here.
Yeah, no doubt.
The studio's a little close for comfort.
Yeah.
Mm-hmm.
Well,
yep.
We love you too. Looking at the 12-month returns, S&P 500 is up 17.65% in the last 12 months. That is hard to believe. Technology's only up 46% as a sector by itself.
If by the S&P you mean a few companies,
yeah, well,
then
it's being driven. It's being driven without a doubt.
Yeah.
By many large companies. Now, we talk about various indices that we measure the market by. It seems more reasonable to measure market returns by the S&P 500 because it is about, these are market cap weighted index.
Right.
Whereas the Dow is a price weighted index. So basically the Dow would be the equivalent of buying one of each of 30 individual companies. And yes, it's only 30. And the one with the biggest price would have the biggest weight in the index.
Right.
In this case, it's more of an economic measure where the S&P 500 weights their portfolio of 500 companies. They are the largest, most liquid companies, but they tend to show a bit more of an economic impact because it's the biggest companies having the most weight. So, companies like Amazon or Apple, it's over $1 trillion in market cap, have the biggest impact. And when they do well.
Yeah. Well, and that's what I've had to tell a lot of clients lately. You got to understand that as they, being as large as they are and doing as well as they have, as they continue to do that, they're becoming a larger part of that index.
Right.
And so, it's driving it even or accelerating it even more with what the S&P is doing. But you got to understand there's downside to that, in just the opposite direction of those. If those companies happen to suffer more when we do see maybe an extended downturn, well, then that's going to be more heavily impactful to the index because you got a larger portion of it now that, there's no rebalancing in the S&P, right? I mean, that just is happening as it happens. Whereas in your portfolio, while you might be happy you've got an overweighting to Apple right now, that may be excessive. And so for most part, you want to rebalance and bring things back in line. And
time to rebalance.
Yeah, it's becoming very misleading to the public, I think, that's because people do see that as a broad index that's doing, fairly well, but in reality, it's not quite what it seems.
Yeah. Jennifer, you shared with us a story about someone very close to you who you finally talked into rebalancing in, back at the first of the year. Yeah. And how'd that go?
Someone who is a close relative of mine that has a substantial amount of Apple stock, more than you would recommend. We say that we never want you to have more than 10% of one stock in your portfolio, and we prefer it not to be more than 5%. Well, I would venture to say it was probably 90% of this person's portfolio.
Yeah.
That's no portfolio.
That's what you call an overweight.
Right. Now, believe me, it's done really, really well.
Right.
But I looked at it, when I'm looking at it from what it did, and I was just going to ask you what your opinion of Apple is, because based on what it did last year, and you probably know the numbers better than I do, but I mean, it closed around $300 a share last year, which was up about $100 a share.
Right. Yeah. About 80%
over the year.
Right.
Yeah.
And
88,
so I told this person in my family, you need to get out of sell, if you're not willing to, cut it back to where it should be, sell 25%.
Sure.
Sell 25% at the end of the year. Sell 25% at the beginning of the year. Take that gain off the table, and spread it over 2 tax years. And then we can talk about it at the, beginning of next year. Well, now here we are, and what I shared with you is I'm looking pretty dumb right now because it's at $450-something a share.
Right. Yeah. Well, and they're about to have a 4-for-1 split. Right. There's a lot going on with the company, and it's technology that hasn't. They've hardly blinked with operations as we've closed down for COVID-19, and they have earnings. Although if you look at earnings, and we're getting toward the end of earnings season for the second quarter, the technology sector by itself has growth of 0.41%, while technology is up over 25. I mean, it's hard to justify. Now, the overall S&P 500 has lost 9.3% in earnings relative to second quarter of 2019. So this is all relative to same quarter previous year. But, it's still, does that justify being up 25%?
No, there's got to be a reckoning at some point. I mean, I'm not comparing it directly to the dot-com era, but this is a very similar thing that we were seeing then, is that you have this unjustified spread between what the stock price is doing and what the earnings are doing.
Right.
And it just keeps getting worse and worse.
Yeah.
I can tell you exactly why it is up, just
Okay.
so you know. It's
All right.
because I recommended my relative to
That's
sell
a great
50%.
point. Yeah, that's always how it goes.
The market is often called the great humiliator, and you got bit most recently. Hey, it happens to me all the time, Jennifer.
You can thank me.
There you go.